This is CGTN, China Global Television Network.
Hello there, welcome to this edition of Global Business Africa. In the course of the hour, we'll run through the business news stories you need to know about from Africa and beyond. Let's start with a quick run through the markets for you. Last year, the month of August, and South African equities had a pretty tepid month. In fact, today's decline of around 1% on the top 40 essentially puts a stop, if you will, to a 4-month rally. Trading volumes have also declined to levels that we saw back in January. Kenya's bourse ends August with a slight gain, but it's fallen by 2.5% in the last 4 weeks. Tesla, on the other hand, had a 5-to-1 split taking effect today. It was just over 9% high at 16:08 GMT. Just in the month of August, the market cap of Elon Musk's electric vehicle manufacturer has gone up by over 50%. Very heady days indeed. Here's what's coming up tonight. Egypt signs up for a $2 billion loan to finance government spending for this fiscal year. Zimbabwe CBZ Bank escapes US sanctions and a near $400 million fine. And we'll take a look at how new restrictions are posing yet another threat to TikTok's sale of its US operations. But let's start the hour up north in Egypt, where the finance ministry is set to obtain a combined blended loan, if you will, worth about $2 billion. Two UAE lenders, NBD Capital and First Abu Dhabi Bank, are joint coordinators and lead managers of that blended arrangement. The loan will help finance Egypt's fiscal deficit for this fiscal year. It will also support the North African economy against a range of global market fluctuations, especially amidst the COVID-19 pandemic. Nonetheless, this new deal does add up to Egypt's fast-growing debt pile. The country's total amount of external debt rose by 17% at the end of last September, recording about $109 billion. Compare that to just $93 billion in external debt at the same time in 2018. Investment bankers in the Egyptian market have ruled out any new offerings coming to the market for the rest of 2020 due to the pandemic. That includes offerings at the level of private sector companies or even government entities coming to the market. CGTN's Yasser Hakim explores some of the effects these new rules could have on companies involved, as well as the stock market.
The Egyptian exchange market has been shocked to hear that new public offerings have been scrapped for now. Investment banks have opted to wait to monitor how the COVID-19 pandemic pans out. Only 2 initial public offerings have been made in 2020. This is seen as a reflection of concerns related to the pandemic.
We can say that the losses have been limited. That's because the government gave huge support to the Egyptian Stock Exchange and central bank pumped £20 billion into the market to make up for the losses and avoid a major shock.
The same has happened with the government's privatization plan. The Minister of Public Enterprises announced that he ordered the 20 state-owned companies and banks to postpone the sale of stocks to the private sector till next year.
Privatization in the current climate will mean the prices of state-owned companies will be unfairly low, so they will use the time to reorganize their structures so that the next year they could attract better offers.
Some experts believe these decisions have not come as a surprise. They just hope the effects of the COVID-19 pandemic would diminish as soon as possible to avoid more losses for the companies and the stock exchange. Yasser Hakim for CGTN, Cairo.
On to a commodity story from East Africa. Uganda has strengthened her position as Africa's largest exporter of coffee with a record 5.06 million bags of those sweet beans flying out of the country in the last fiscal year. Export earnings also hit an all-time second-best level of $494 billion. Coffee is one of the 14 commodities identified by the government in Uganda as being critical to the economic transformation of the country, especially in the aftermath of the COVID-19 pandemic. CGTN's Michael Baleke filed this report from Kampala.
Paddy Mubiru has been growing coffee for more than 30 years. He has a fairly large coffee farm spanning about 10 acres. Coffee runs in the family and has passed down for generations.
My father was a coffee farmer. He paid our school fees from coffee proceeds. Our livelihood depended on coffee. As soon as I left home, I bought land and started planting coffee. I've also taken my kids to school using coffee. I'm now retired and coffee takes care of me.
About 1.7 million households in Uganda depend on coffee for their livelihood, according to the Coffee Development Authority. The harvest season is just setting in and Pade expects to gather more than 2,000 kilograms of coffee beans. He says the 4 months he spent tending to his garden during the COVID-19 lockdown have paid off with better yields. Paddy is among the army of farmers that have made Uganda Africa's largest coffee exporting country. In the financial year ending June 2020, Uganda's coffee exports set an all-time new record of 5.1 million bags worth $494 million compared to 3.9 million bags worth $415 million the previous year. The increase in production and export volumes is attributed to the replanting program that has been ongoing for the last 10 years.
At the moment, government has very demanded to produce and multiply seedlings, coffee seedlings, so that we can promote production, and we are on the ground running up and down and mobilizing farmers. And the good news is that everybody's embraced coffee.
More than 900 million seedlings have been distributed so far to replace the trees lost to the coffee wilt disease. The national plan is to increase production to 20 million bags by the year 2025. And the Coffee Development Authority says this will require the rehabilitation of old trees and research into disease-resistant varieties.
What we see is that more and more middle-income earners in big offices and those with large chunks of land also coming in coffee. So we think we are going to hit the target, and the plan from the government is that we should be planting 300 million seedlings every year.
The COVID-19 pandemic has not had as much effect on coffee production compared to food crops like matoke. And some farmers like Paddy say the lockdown has been to an extent a blessing in disguise.
The pandemic restrictions on movement have forced us to stay in our gardens and give our coffee trees extra care. The more time you give to coffee, the better returns. Our only challenge was access to pesticides for bacteria and the coffee wilt, which is still killing some of our trees.
Uganda grows Arabica and Robusta coffee varieties, and the government is looking at the beverage as one of the commodities critical to the economic transformation and recovery of the country in the wake of the pandemic. And the hope for farmers like Paddy is that the increase in coffee earnings is also reflected in their pockets. Michael Baleke, CGTN, Kampala, Uganda.
All right, then. At the start of the hour, we mentioned that Egypt has essentially tapped capital markets for about $2 billion in essentially a blended finance facility. Let's see exactly what this means for the North African economy in the 2020-2021 fiscal year. CGTN's Adel Marouki joins me now with the details on this from Cairo. So, Adel, let's start with a bit of, sovereign finance 101. Part of this facility, about $510 million of it, is essentially an Islamic finance facility. It's not conventional credit in the way we understand it. So for a sovereign borrower like Egypt, how does this work? What are the terms on which such a facility is repaid?
First of all, Ramah, Egypt doesn't really, the government is not really concerned if this is an Islamic or a conventional loan. But still, the difference would be mainly in Islamic financing, we do not focus on interest in terms. There is no fixed interest on the loans that are given. Usually it is quite bound to a variable, and therefore it is not a fixed promise of return of amount of money over the loaned finances in general. And this is what mainly justifies what is the Islamic financing. It has to be compatible, compliable, it has Sharia law compliancy, and this is the key here. It also restricts the kind of industries or businesses that you would use this loan for. So any industry or business that violates the Islamic Sharia would not be compatible with or would not gain the term of Islamic financing. That's generally. For this specific one, we're talking about, it has been bound to a percentage equal to the LIBOR, which is the London Interbank Offered Rate on the US dollars. It is set to be, for now, it is 0.25% quarterly every 3 months. And in addition to that, it will be there will be added a 365 basis point to that sum. This will be paid in evenly installments. The Egyptian Finance Ministry will be committed to pay these, and then after 1 year, the Finance Ministry will have to pay the entire loan in full. The entire $2 billion will be paid in full. So that's basically it. It sort of gets away from the interest labeling and put it in sort of fees or other terms that would really make it more or less compatible or give it the Sharia, the Islamic law, Sharia compliance.
Indeed. So Egypt, though, has a fiscal deficit of around $25 billion in this fiscal year that it needs to fill in. With this $2 billion loan in hand, how much else is the country looking to borrow in international markets, at least in the next 10 months?
So Egypt did not make a clear announcement of the target loans that it needs for the COVID-19 repercussions and to cover the deficit, the impact the pandemic had on the market. But we know that so far Egypt has borrowed from 15 to 17 billion US dollars. That's including, if we want to include the loan that we're talking about today that is coming from the UAE, the bank consortium that is led by Emirates NBD and First Abu Dhabi Bank. That's what the government has gained so far. Are there any intention further? The government doesn't seem to have a clear statement on that, but it is moving. It has been moving already to maintain or to approach almost all debt tools available. 5 billion of these $17 billion in loan were through euro and dollar bonds, and the government is still pursuing, as we've seen, the latest one. So for the UAE's loan, for instance, the first target was to get $1.5 billion. But once the government found that it has been gaining registry for 1.75 times the amount it wanted, it raised it up to $2 billion. So it seems that Egypt, when even approaching such debt tools, the government tries to get the best out of this opportunity, which is an indication that there is a hunger for more financing. But how much? That's a question that the government has not answered yet.
Indeed. One last question for you. The budget, of course, for this fiscal year, it forecasts tax revenues of around 1.3 trillion Egyptian pounds. It works out to roughly $81 or so billion. Is that tax revenue forecast still the same despite the damage inflicted by the pandemic, or has it been revised downwards?
No, this forecast is still the same, at least so far. As you said, around 81 billion US dollars, 1.3 trillion Egyptian pounds. That's actually an increase from the fiscal year that has just ended, the 2019-2020, which ended at 1.134 trillion Egyptian pounds. That's about 71.7 billion US dollars. There is an increase speculated by the government that is basically driven from several tax reforms and tax implementations. For example, there's an addition of 1% gross income tax applied for anyone who is getting paid more than 2,000 Egyptian pounds. That's roughly 130 US dollars or so. The government is also have been moving to make tax reforms to, for example, collect revenues from previously exempt institutions on returns from their investments in government treasury bonds and bills. This will also be bringing up and incremented revenues in terms of tax. That's in addition to the delayed tax from this year that the government has facilitated over 6 months, which means it will cross into the next fiscal year as well. All of this supports the government projection that it will be, in fact, getting more taxes next year.
Indeed, let's see how the numbers do turn out. Adel Mahrouki there live in Cairo. Time now for a run through some company headlines. Let's start in South Africa. AngloGold Ashanti and Barrick Gold will be selling their 80% stake in the Morila gold mine in Mali. Now, that decision comes as the political crisis grips the West African nation after soldiers over there seized power in a coup d'etat. AngloGold Ashanti says that an Australian company, Mali Lithium, will buy the firm holding the two minor stakes. The Morila gold mine stopped operations in 2019. It's currently processing only ore stockpiles. Elsewhere, Sun International is planning to cut some 3,300 jobs in South Africa and Chile. The move is part of a restructuring plan in order to ensure that the business does survive this pandemic. Sun International says the pandemic took the firm into a half-year headline loss of some $53 million. In the 6 months ending in June, the casino and hotel company also reported impairment charges of over $70 million related to its hotel and resort properties. In West Africa, Nigeria's multinational commercial lender Access Bank has renamed Transnational Bank after it completed the acquisition. The Kenyan lender will now be known as Access Bank Kenya. The buyout by Access is now deepened the presence of Nigerian banks in the East African nation, with United Bank of Africa and Guarantee Trust Bank, or GT Bank if you prefer, already in the market. And Coca-Cola is set to cut some thousands of jobs and reduce the number of business units as it faces declining beverage sales due to the pandemic. The job cuts will come in the form of voluntary and involuntary reductions. Coca-Cola plans to first offer buyouts to some 4,000 employees in the United States, Canada and Puerto Rico. The beverage company plans to reduce its number of operating units from the current total of 17 businesses in 4 geographical areas to 9 operating units in those same regions. That's a run through your company headlines. You're watching Global Business Africa. Time for a short break. Here's what's coming up. Zimbabwe's CBZ Bank escaped US sanctions and penalties. We'll explore how that happened. And South Africa banks on domestic tourists to restore the industry's fortunes. The details are coming up next.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business, only on CGTN.
Every story starts out like this.
Okay, we'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible? And why?
Let's get some reaction on ground. Joining us in Johannesburg is Sutra Nairobi. Hello, Nairobi.
This is how all stories begin. See how they end. Only on Global Business.
Welcome back to the program. Now let's turn our attention to Zimbabwe, where one of the country's largest banks, CBZ Bank, is now free to develop its international business after the US Treasury cleared it of a $385 million penalty and instead just gave it a warning. Now the penalty had been imposed on the CBZ back in 2017 by the US Treasury's Office of Foreign Assets Control, or OFAC as it's more commonly known, for processing transactions on behalf of ZB Bank, a local lender which was under American sanctions. Now, the lender was placed in a list of firms under sanctions in 2008 and then later removed in 2016. OFAC had previously said that it had determined that for a number of years, up to and including 2014, CBZ appeared to have engaged in non-transparent payment practices and processed thousands of transactions to or through the US in apparent violation of sanctions that had been applied on that bank. All right then, so let's explore exactly what happened here and what's next for CBZ Bank. Farai Makutuya joins us now live from Harare with a lot more data on this story. So Farai, let's start with a bit of history here. 2017, when this penalty was originally announced, and it was much bigger back then, what exactly triggered this chain of events?
Well, indeed, Ramah, as you mentioned, there CBZ was sanctioned because of providing indirect access to customers of ZB Bank. That is a state-owned bank. It is a commercial bank in which the government has the majority shareholding, but also allowing customers of that bank who were on a list of sanctioned individuals, people who are targets of these smart sanctions imposed by the US, to engage in transactions in US dollars and also internationally to the US in violation of these laws. These transactions date back as far as 2007, 2008, 2009. And so that is the reason why CBZ was sanctioned at that point in time, for providing this indirect access without declaring it or notifying US officials that they were indeed transacting on behalf of ZB Bank, a sanctioned entity, but also transacting on behalf of customers who were part of the targeted sanctions list.
Indeed. So given the country's economic crisis and the sanctions that we're seeing that are still apply on some entities within the country, walk us through the status of correspondent banking relationships between banks in Zimbabwe and banks in the United States. I imagine it must be pretty difficult to have those relationships still intact at this point.
Well, indeed, Ramah, I think, these correspondent relationships are effectively non-existent or not in operation because of those embargoes that exist that have been imposed by the US. Any funds coming destined for Zimbabwe are held up within the US financial system when they pass through New York, and any funds coming out of Zimbabwe are held up as well. I think a lot of companies and even individuals have said that when they try to make even online payments, the minute they state that they are located or are in Zimbabwe, within Zimbabwe, they are notified that they can't make that transaction, that transaction is not possible to effect. And so, the challenge is that even where, individuals are not sanctioned or companies are not sanctioned or are not part of the sanctions list, it has made banking institutions and companies in the US weary of dealing with Zimbabwe, of sending funds to Zimbabwe, because they're just not sure what will happen, whether or not they're in violation of these laws. Last year, 2019, we know that Standard Chartered was fined $18 million for facilitating payments that were in violation of these regulations dating back again as far as 2009. And so when you see that sort of precedence, when you see this sort of punitive measures put on financial institutions as big as Standard Chartered, I think that gets people very wary, very anxious, and very skeptical. And I think it makes it difficult for Zimbabwe to participate in the international financial market, because you can't send money, you can't receive money, you can't borrow money, and you can't transact with anyone, because they're just not sure whether or not they're allowed to do that, or if they'll be punished in future for doing so.
Indeed, the risk involved is just simply too high. One last question for you, Farai. When the finance minister was appointed, Professor Mtulinkube, when he was appointed, one of his first priorities was trying to clear the arrears, I believe $7 billion worth of debts that Zimbabwe owes to a range of multilateral institutions. But now we're seeing the IMF and the World Bank saying, yes, you've cleared the arrears due to the IMF, but we're still not going to lend any money to you. It's the same story with the African Development Bank and a bunch of other multilateral institutions. Where did this arrear clearance plan go off the rails?
Well, I think, the intentions by the finance minister were very clear, that he wanted to clear these areas to get Zimbabwe readmitted into the international financial community. I think there have been a few unforeseen, circumstances that were unplanned for, things that, he didn't think would come up. For instance, the cyclone that affected the eastern part of the country in 2019, the drought, one of the worst and most severe in the history of the country. Now, both those natural phenomena have meant that funds that were meant to be, dedicated to paying off some of these arrears have had to be redirected to humanitarian and emergency relief. You also look at the cost of living, inflation. Zimbabwe has, on its staff monitored program that was being monitored by the IMF, had been encouraged not to effect any increments or any wage adjustments, particularly to public servants that would be outside its means, not to spend beyond its means, particularly where wages are concerned. But I think because of the inflationary environment, because of the challenges we've seen in the cost of living, as well as the COVID-19 pandemic, government has had to make that expenditure to effect those increments and adjustments on a humanitarian basis. And I think that has derailed that plan in terms of what government was planning to do in terms of clearing its arrears. We also know that the finance minister had a plan in place where he was planning to get some funding from the G21, where he was going to get funds from there and then use that to pay off this big debt to the IMF, the World Bank and the AFDB, which would then reopen access to funds. Unfortunately, that also hasn't materialized. So there have been a couple of factors that have militated against this plan, both natural and also man-made. And so that is why we're in the situation where we are in now. But also bear in mind the fact that as long as these relations between Harare and Washington remain frosty, tenuous and strained, the IMF, the World Bank, and those sort of multilateral institutions will be averse to lending or admitting Zimbabwe into any sort of financial arrangement because of those sanctions and restrictions that are in place.
Indeed, it's a very complicated problem to solve for Ramah Nyang in Harare. Thank you very much. Now, of course, we're still in Southern Africa. In the wake of a 5-month lockdown, one of the most determined across the continent, South African authorities are now gradually easing domestic travel restrictions. They've allowed hotels to reopen. But with international borders still essentially closed off, the government is now pinning its hopes on a sort of recovery on domestic tourism, essentially echoing a strategy that's been tried in other markets, New Zealand and Vietnam. But the results have been pretty mixed so far. Here's CGTN's Alexander Majala with a perspective from South Africa.
Most of Cape Town's tourist hotspots are normally abuzz with tourists from around the world. But today, these same sites are mostly empty, with only a few local customers coming in now and then to enjoy the city's scenic views.
We have done a 50% off on all of our properties. The reason for that really is to get South Africans to engage in a staycation and enjoy their own country, which I think a lot of South Africans will do, although financially a lot of them also been hit quite hard.
South Africa remains among the countries hardest hit by the pandemic. And with recession-battered consumers watching their pocketbooks, many in the sector foresee an uphill task. Of tourism businesses responding to a recent government survey, 64% were unable to service their debts in May and 67% could not meet fixed costs. To cope, many businesses have laid off staff or slashed wages. Others have gone bust.
The hardest hit obviously have been the hotels. Most of our hotels are kind of upper end here, so most of the 5-6-star hotels are closed and they don't intend to open before December. After the hotels, the next worst hit has been restaurants. We've got about 80 restaurants within the waterfront and all of them closed.
Last year, South Africa welcomed over 10 million international visitors. SA Tourism, the sector's marketing agency, was targeting 8.7% year-on-year growth in inbound arrivals in 2020, with total tourist spending projected to reach $16.2 billion. But COVID-19 brought the sector to a screeching halt as governments closed borders and imposed lockdowns.
The closing of our borders has impacted us because 70% of our tourists are international, especially in the Safari Lodge properties. So at this point, those properties are not being booked at all. Local tourism really in Cape Town it can survive, but it's at a hugely reduced rate. So for us, we really are opening just for the purpose of keeping our staff employed.
According to SA Tourism, nearly 440,000 tourism jobs are at risk this year. The sector is expected to lose 75% of projected revenues, which is $4.7 billion. With South Africans now permitted to voyage between provinces for the first time since March, tourist-focused businesses are pivoting to domestic travelers in a bid to stay afloat. In a sign of faith in domestic travelers, restaurants on the city's waterfront are recalling furloughed staff, and game reserves further inland have begun preparing campsites for visitors. Alexandria Majala for CGTN.
Now back to East Africa. Before COVID-19 landed on our shores, horticulture exports from Tanzania were growing at an explosive pace. They actually surged by a factor of 12 in the last 5 years, becoming a leading subsector that's driving agricultural growth. According to the Tanzania Horticultural Association, exports value surged to $779 million last year. And remember, we're talking about a sector that exported goods worth just $64 million back in 2004. Foreign direct investment has played a key role in increasing the growth of the industry by importing the tech and the expertise needed to improve yields. That in turn saw farmers improve and productivity go up. Horticultural crops grown in Tanzania include flowers, veggies, fruits and spices. The government plans to revive the leading horticultural estate on the southern slopes of Mount Meru in Arusha. The idea is trying to bolster horticultural production and increase the annual export value of horticulture from $777 million to at least $3 billion by 2025. All right, then, quite a bit to get through on this particular topic. Jacqueline Kendi is the CEO of the Tanzania Horticultural Association. She joins us on the line from Dar es Salaam tonight. Thank you very much for your time this evening. Let's start with the cessation of flight, at least in the early days of the COVID-19 pandemic here in East Africa. In April, you had to work to secure regular air freight space in order to keep produce flowing out of Tanzania. Is that arrangement still in place?
Yes. When the airline ceased flying into Tanzania, our produce were almost cut off from the international market. But we had to quickly intervene, acting outside the box, and we managed to negotiate with Ethiopian airline to bring a freighter into Kilimanjaro International Airport, and the flight is still coming, uplifting our produce from Kilimanjaro to international markets in EU.
So to what extent is this row that we've seen between Kenya and Tanzania over flight access to their respective markets, to what extent has that limited your members' ability to get their produce to market?
Yeah, before COVID-19, actually, we used to, and even before, some years ago, we used to export almost 60 to 70% of what we produce here through Jomo Kenyatta International Airport. And this was mainly because we didn't have enough space, cargo space, out of Kilimanjaro or Dar es Salaam Airport. And of course, another reason was we didn't have a clearing agent for perishable handling in the country. But since then, we've built our own capacity, and we've started uplifting out of Kilimanjaro Airport and also out of Dar es Salaam. And recently, we also started shipping out our fruits through Mombasa, through Dar es Salaam port. So yeah, we used to be hugely impacted because of the competition at Jomo Kenyatta International Airport, but now we are able to uplift our produce out of Dar es Salaam, Kilimanjaro, and also from Dar es Salaam port.
Indeed. What is required in terms of cutting taxes, but also trimming customs procedures in order to ensure that the primary point of exit for Tanzanian produce is either Dar es Salaam or Kilimanjaro or the port in Dar es Salaam?
Apart from taxes, of course, there are a number of issues that still need to be done in Tanzania, just to make sure that our produce are being transported out of our facilities here. Of course, enabling environment, that means the reviewing of our taxes is critical. And these include, the landing fees for our airports, but also the charges that we charge the vessels that come to Dar es Salaam port needs to be reviewed so that we are able to attract vessels to come to Dar es Salaam, but also attract cargo planes out of our airports. Another very important issue that needs to be addressed, of course, is streamlining our perishable handling procedure and processes at our ports and airports so that we have the green channeling, the fast tracking of horticulture or perishable handling at the ports and airport. This is very critical. And this should go hand in hand with actually building the capacity of our people at the ports and airports so that they know how to manage perishable cargo. And this is not only about horticulture, but it's also about the beef and also fisheries products to be exported from our port. So enhancing the skills that is required is important for improving efficiency and effectiveness when it comes to managing cargo at the port.
Indeed.
And of course,
All right, we'll leave it there for the time being. Jacqueline Kindi, CEO of the Tanzania Horticultural Association. Thank you very much for your time this evening. Now, you're watching Global Business Africa. Here's what's coming up shortly. We'll look at new restrictions that pose a further threat to the sale of TikTok's operations in the United States. And the top Italian designers donated some 13 million euros worth of clothing that was unsold because of COVID-19 lockdowns.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant.
Only on CGTN.
How will your world change today? What happens here? What happens there? Or what do you make happen for yourself? If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
All right, then welcome back to the program. These are the stories making you headlines at this hour. Starting in Sudan, the transitional government there has signed a peace deal with rebel groups. That deal essentially ends a 17-year-long conflict. Since late 2019, the Sudanese government has been in negotiation with the Sudan Revolutionary Front. The SRF, as it's known, is comprised of rebel groups from Darfur, South Kordofan and the Blue Nile regions. Representatives of these groups were in the South Sudanese capital of Juba for the signing of this peace deal. Two rebel groups, however, did not join in this agreement. The final peace deal covers issues around security, land ownership, power sharing and a range of other metrics. Egypt, in the meantime, says 77 militants have been killed in anti-terror operations in the country in recent weeks. The North African country's armed forces say the 6-week operation targeted alleged homes of terrorists. The military says 3 officers and 4 soldiers were killed or wounded in the operations. The South African President Cyril Ramaphosa will appear before the governing party's Integrity Commission over controversial campaign donations, that's according to the Deputy Secretary of the ANC. The head of state reportedly received $35,000 back in 2017 when he was running for the leadership of the African National Congress. And finally, Rwanda says it has arrested Paul Rusesabagina. If that name sounds familiar, it's because he is known to most of us around the world as the former manager of the Hotel de Mille Collines. Rusesabagina is said to have helped hundreds of Tutsis escape massacre during the genocide in 1994. His story inspired the production of a Hollywood movie, Hotel Rwanda. His arrest, however, comes in the wake of allegations that he's been sponsoring terror groups in the country. The government, however, has not disclosed the details of his arrest. The 66-year-old has been in exile in Belgium and the United States since 1996. The Hotel Rwanda individual, of course, will keep a very close eye on that story for you here on the program. That's a run through your headlines. Onto the world of tech now. TikTok's race to keep its operations going in the United States could face a new hurdle after China imposed new restrictions on technology exports. The popular video sharing app has been scrambling to reach a deal with an American buyer after President Donald Trump ordered it to stop or sell its operations in the US. But these new rules, which essentially require government approval for certain exports, especially of tech, are likely to affect its Chinese parent company, ByteDance. Exports covered by the list need prior approval from the Commerce Ministry in China, and that is a process that can take up to 30 days.
The purpose of China's new export rules is to regulate technology export management, facilitate technological advancements, and cooperate with foreign countries. It also aims to safeguard national economic security. The US has been using tactics of economic bullying and political manipulation against non-US companies. Whether it is political coercion or government coercion, it's no different than usurping.
On to the Driving New Growth series. In today's episode, we're going to be taking a look at China's efforts to open up its bond market to foreign rating agencies. Market players say the move could improve the rating quality of Chinese fixed income instruments, reduce the rate of defaults, and increase attractiveness to international investors. CGTN's Weilin Tang takes you through this report.
Capital market players say it's a long time coming for wholly owned foreign credit rating agencies to rate the domestic Chinese bond market. S&P Global Ratings got the green light in January 2019, an unprecedented step. Half a year later, it rated its first domestic issuer in China. In May 2020, Fitch Ratings secured approval to rate financial institutions and structured finance bonds in China's interbank market. The American credit rating agency hails the timing.
Chinese bond market are becoming attractive to foreign investors for a number of reasons. First, a number of bond indices have added Chinese bonds, and investors who are benchmarked against those indices will need to include Chinese bonds in their portfolio. Additionally, the yield for Chinese bond is higher than most developed markets at this point, which I think investors may find attractive on a relative basis.
Kwong says the escalating China-US tensions is a key risk investors are watching out for. But he points towards the strength of China's bond market.
As the second biggest market in the world, I don't think it can be ignored by any investors. And as the Chinese economy further develops, there'll be a strong need for financing from many Chinese companies. So I think it will continue to grow, and perhaps one day it will eclipse the U.S. market.
What challenges do you foresee to navigate when Fitch asks China to start rating its financial institutions and its securities?
We utilize international best practice, and I think we are much more rigorous in our analysis. And obviously, I think a lot of investors and issuers in the market are very used to the current rating level. So I think it'll be a long education process for us to get investors and issuers comfortable with the ratings that we put out and to understand the more in-depth analysis that we provide.
Companies raise funds through two main types of capital: debt, which includes the issuance of bonds, and equity. Investors who choose to buy these bonds rely on reports that evaluate the credit worthiness of companies. For some time now, market watchers have brought to light the stark differences between domestic Chinese ratings and foreign ratings. A June 2017 report by the Bank for International Settlements showed international agencies graded Chinese bonds up to 7 notches lower than their Chinese counterparts.
The idea is that, in order for the market to continue to grow, we have to bring in a more diverse investor base. Right now, the market is very crowded with only issuers rated AA- or above because it's very hard to get issuance out with lower ratings.
Yeah.
I think by allowing international financial intermediaries like ourselves to come in, it will give more confidence to foreign investors who might be interested in investing in the lower end of the rating scale to come into the market and have more confidence investing in companies. Because right now, I think they feel that there's not sufficient transparency or sufficient analysis on the companies that they may want to invest in.
Transparency, credibility, and analysis. Keywords that market players are vying for China's bond market to possess to truly attract global investors. Fitch says it's in the process of talking to a number of issuers and hopes to have some ratings published in the next few months.
Weilin Tang, CGTN, Beijing.
The Turkish economy recorded a near 10% year-on-year contraction in the second quarter of the year. This is the sharpest ever quarterly drop since the start of this current GDP series back in 1998. Now, the decline was mainly driven by record falls in private consumption and a collapse in exports due to COVID-19 related restrictions. From Istanbul, here's CGTN's Michal Bardavid.
Turkey's Statistical Institute Turkstat announced that the country's second quarter GDP shrank by 11% from the previous quarter, which makes it the worst fall since 1998. This means the country's economy shrank by just under 10% when compared to last year. The year had begun with positive signs. Turkey's economy had grown by 4.5% in the first quarter, and the government was hopeful to end the year on a positive note. But like most countries across the world, COVID-19's impact hit the economy hard. Though the government tried to prevent a financial meltdown by not imposing full nationwide lockdowns, many businesses and factories were shut down during partial lockdowns. And when travel restrictions began, the tourism industry began to suffer and continues to do so, as visitor numbers fell dramatically, far from seasonal averages. In 2019, tourism revenues had reached $34.5 billion. Meanwhile, as the fight against COVID-19 continues, there is a bit of a relief in sight. The China-backed Asian Infrastructure Investment Bank announced on Monday it would be lending Ankara over $83 million to support its struggles with the pandemic. The financial aid is aimed at funding the medical sector and increasing the capacity of public hospitals. Despite the downturn, Turkish officials remain optimistic. Turkey's Treasury and Finance Minister Berat Albayrak stated that he was hopeful the country would end the year positively with an economic model that supports its citizens and that the country could see a V-shaped recovery in GDP data at the end of the year. I'm Michal Bardavid for CGTN in Istanbul.
Now, many luxury fashion brands had to shut down their stores worldwide for months due to the COVID-19 pandemic, and that in turn has left virtually all of them really with these massive stockpiles of unsold and now out-of-season merchandise. But as CGTN's Hermione Kitson now reports, the Italian brand Brunello Cucinelli's answer to this problem is to literally give that stock away instead of market it down or selling it to a discount retailer.
He's Italy's self-made king of cashmere, whose designs date back 4 decades. But even for Brunello Cucinelli, this is a period like no other.
It's been a particularly painful and intense period that I would like to call a moment of passage towards a new life.
Europe's longest COVID lockdown took its toll on the luxury brand, leaving €30 million worth of clothing unsold in shops worldwide. Now Mr. Cucinelli will donate it all.
We've decided this surplus of new products should be destined for humanity. We will send these packets to parts of the world where we have friends and partners.
This is a generous company for both workers and the rest of the world, so this project is really a reflection of the owner's soul.
Synonymous with the brand is Solomeo, a medieval village in the picturesque hills of Perugia that he spent years restoring.
We wanted this village to be how it once was, as a centre of production for olive oil, wheat and wine 1 century ago, and now of cashmere.
The company employs 2,000 people around the world. Half are based here in Solomeo, and despite the economic challenges of recent months, no jobs have been lost. The well-being of workers is at the company's core.
The fact that Mr. Cucinelli said our jobs are secure for the next 2 years has prevented our families from suffering more than we already have due to the pandemic.
And despite this period of uncertainty, they're looking ahead to 2021.
Just last week, we launched the Spring-Summer collection physically in every part of the world, from Shanghai to New York and Milan. And it seems we've created the best collection of the past 40 years.
The businessman and philosopher says now is the time to act for generations to come.
Don't plan just for the next 3 and 30 years, but also the next 300 and 1,000 years. Don't be scared, be courageous, and tomorrow transform your fears into hope.
Hermione Kitson, CGTN, Solomeo, Italy.
Now, one of London's central major thoroughfares has been transformed into a place that prioritises people walking and cycling. The rest of us with our cars can stay out of the way. New traffic restrictions between Shoreditch and London Bridge are part of Transport for London's response to this pandemic, and that's helping to create a lot more space for walking, improving cycling conditions, and to allow people to maintain social distancing, especially at busy times. CGTN's Nawi Jabahil found this report.
Nabi Toktash recently bought a bike. Cooped indoors as a result of COVID-19, he eventually chose to ditch his car in favour of two wheels.
And I decided to cycle to work because we've got wider paths now, it's much safer and it's easier to cycle now. And of course the cost as well, because we have lost many income, so we had to cut down on cost. And the car, costs normally £100 a month, whereas this one is only £10.
Nabi's not alone. Thousands of others in London are also turning their backs on automobiles. The Mayor of London has launched a programme called Street Space that aims to boost cycling lanes and widen walkways. Sadiq Khan says the move will enable better social distancing while reducing pollution. As lockdown measures are eased further, officials are gearing up for a 10-fold increase in cycling and a 5-fold increase in walking. Experts say other global cities are thinking along similar lines.
The avoided costs of the ravages of the pandemic, economic, health, and otherwise, and also the current and especially the future costs of climate change, those costs will be much greater than spending on appropriate infrastructures to improve our cities so they'll be resilient and sustainable well into the future.
Changing central London's historical streets is a bold move and will likely cost taxpayers hundreds of millions of dollars. That's an important consideration at a time when COVID-19 has damaged the economy and public finances. But supporters of the move say the health benefits of more walking and cycling and fewer cars on the road will mean it's money well spent.
The Mayor of London's office declined an interview request but said cleaner air is a priority. For Nabi, he's enjoying the novelty of zipping around the city, but he's realistic about the limitations of cycling.
I'm a small business owner. I mean, although I can cycle to work and back, there are certain things which is not doable by a bicycle, so you have to use your car.
For those that do want to keep on driving in London, they'll soon be sharing these roads with a few more bikes.
All right then, speaking of things that unfortunately will still pollute the air, Brent crude, as far as August is concerned, it's not particularly bad. Brent is up 5% in the last 4 weeks, WTI up 7%, copper contracts in New York at the highest since mid-2018, one trading in London today. Back on the continent, as I mentioned a little earlier in the hour, AngloGold Ashanti and Barrick Gold essentially cashing out of Mali by selling their 80% in the Morilla gold mine. An Australian company, Mali Lithium, essentially buying that out. The estimated price is about $22 to $27 million. But neither mining company mentioned the evolving political situation in the country when they were announcing this particular sale. Here's what's coming up next. Tomato farmers in Cameroon are counting their losses as pandemic restrictions have cut off cross-border trade.
You don't find the stories of North Africa by sitting on the sidelines. No one else will take you where we can in North Africa. And no one else will show you what it's all about. CGTN, see the difference.
Welcome back to the program. Now, after Cameroon's government pushed hard to expand tomato farming to boost incomes and alleviate food insecurity, a lot of Cameroonians switched over to growing that particular fruit. But a failure to develop the support infrastructure and the food processing industry has now left thousands of these farmers in the cold when COVID-19 triggered border closures. And that in turn led to an overnight loss in export income, and it flooded the local market with one too many cheap tomatoes. CGTN's Mohammed Abubakar has that story on Grassroots.
Dorcas Anjuk is used to good years. She has been growing tomatoes in the fertile lands of Nyokon between central and western Cameroon for 6 years. In a good year, Anjuk makes twice what she and her husband invested in these 6 hectares of land they farm today, which was around $10,800 US. This season, however, things have taken a turn for the 24-year-old. Due to the COVID-19 pandemic, Anjuk has lost all business. And with a massive oversupply of tomatoes on the local market, the little red fruits now lie on the ground unharvested and rotting.
We have lost a lot. We invested over $10,000 on 6 hectares and we haven't been able to earn profit. I say profit as if we had managed to get that back, but in fact, we have not been able to even harvest from the field, since every time we have picked tomatoes, we ended up with nothing. Sometimes, we even had to dig into our own pockets to pay the workers that we took. We haven't been able to get our money back.
Anjuk is not alone. Thousands of other small-scale tomato producers in Cameroon are also facing huge losses.
I have 7 children. How will I be able to feed them? When I work here, I am able to buy some maize to feed them and also send them to school. But this year, I'm not sure what to do. I don't know how I'll put them through school.
Cameroon's state broadcaster CRTV reports that at least 2 tomato farmers committed suicide in July because they could not pay back the money they borrowed to produce their crops. Farmers would normally sell more than 80% of their harvests in large-scale lots to buyers from neighboring countries like Nigeria, Gabon and Equatorial Guinea. But those buyers are no longer coming, with COVID-19 lockdowns hitting transport and cross-border trade.
Previously, during this period, we would sell a basket of tomatoes for 7,000 to 6,000 francs. But now we cannot sell a basket for even 5,000 francs. We have a surplus on the market. This is because foreign buyers are unable to come into the country due to the closure of the borders. Now in the market, a basket of tomatoes goes for 3,000, 2,500 to 2,000 francs, or even less.
As part of Cameroon's 2035 development plan, over 12,000 young people have gotten government support over the last 5 years to start growing tomatoes or other vegetables. Official statistics put tomato production in Cameroon at about 878,000 tons in 2019. Estimates for this year's harvest have not been released. But farmers, especially women and young people whose main income comes from growing tomatoes, say they will need state subsidies to stay in business after this tough year. Mohammed Abubakar, CGTN.
Now, the weekly debt auction last week in Kenya had a pretty dismal subscription rate, just about 52.3%. That was, to be fair, higher than the previous weeks, 40.4%, with a lot of focus on the short end of the scale. The 91-day T-bill is getting a lot of attention. It had a subscription rate of over 110% last week. But all of this is because we had an issuance of an 11-year note, and that grabbed fund managers' attention and, of course, a fair bit of funds last week. Kenya's inflation data for August, 4.36%, pretty much the exact same number as July's figure. Those are your currencies, and that's it for this edition of Global Business Africa. As always, we'd like to hear your thoughts on the content you've seen on the program in the last hour or so. There are many ways to get your thoughts back to us, all of them on your screens right now. I'm Ramah Nyang in the Kenyan capital, Nairobi. The World Today is up next from Washington, D.C.